Hello, and welcome to the inaugural episode of Remember That. In this series, we will explore tax items that may not be entirely new, but will still have an impact on current and future tax returns, so are worth remembering. My name is William Birmingham, and I'll be your host for this episode. Today, we're discussing the $10,000 state and local tax, or SALT, deduction cap, and its interaction with state charitable tax credit programs. This was a big deal for some states in 2018, as we shall see, and will most likely continue to impact future returns through its sunset date in 2025 unless Congress decides to make changes. So let's get started with a quick overview of what's changed. This is Schedule A from 2017. I imagine we're all pretty familiar with this form. State and local tax deductions are added up on lines 5 through 8, and the total is carried to line 9. This total is then added to other itemized deductions and then carried to Form 1040. Let's do a quick example to show how that might turn out. Let's imagine that 2017 income taxes paid to the various states was $15,000. Real property taxes were $5,000 and no other state taxes were paid. Let's also assume $10,000 of charitable contributions made in cash and no other deductions. If we add these up, we get a total of $30,000. Let's also assume the so-called P's limitation here at the bottom does not apply. Now we have our total itemized deductions for 2017, so let's move over to the 2017 Form 1040. The first page of the 2017 Form 1040 is used to add up all income reduced by so-called above-the-line deductions. Ultimately, the first page results in adjusted gross income, or AGI. To keep things simple, I will assume $100,000 of wages is the only item of income, so that gives us an AGI of $100,000. Our $100,000 AGI will transfer to the first line of page 2, and this is where it will be reduced by the itemized deductions we calculated earlier. So let's enter $30,000 here on line 40. That will reduce AGI by $30,000 and result in a taxable income of $70,000. I will assume a straight tax rate of 20%, so that will give us a tax liability of $14,000. Note that this is not a realistic example, as we have not included exemptions and the tax calculation is not correct. The point is just to give us some bearings for what we will encounter later in this discussion of the SALT deduction cap. So this very simple example demonstrates what itemized deductions do. They reduce AGI and hence taxable income, so they reduce tax. In this case, since our tax rate is 20%, the $30,000 of itemized deductions reduced our tax liability by $6,000. We can check this by calculating the total tax on AGI at 20%, which would be $20,000, and comparing this with our $14,000 of tax on $70,000 of taxable income, and noting the difference is, in fact, $6,000. Note, it never works out this cleanly on a real return. Next, let's take a quick look at lines 48 through 54. This is where federal tax credits are shown, and the total is brought into the calculation on line 55. Let's imagine this taxpayer qualified for a $1,000 child tax credit. This $1,000 credit is quite different from a deduction in that it offsets our remaining tax liability dollar for dollar. In other words, a $1,000 credit reduces tax by $1,000. In order to achieve the same result with a tax deduction, we would need a $5,000 deduction because $5,000 multiplied by our 20% tax rate gives a $1,000 reduction in tax. So a tax credit is far more valuable than a tax deduction of the same amount, since a tax credit reduces tax dollar for dollar and a deduction only reduces taxable income. Okay, that should give us the background to understand what happened in 2018 and why it matters. So here is the 2018 Schedule A. As you'll notice, the taxes you paid area has changed. Now, state and local taxes are shown on lines 5A through 5C and added up on line 5D. But then something different happens on line 5E. The total of all state tax deductions is limited to a maximum deduction of $10,000. If we put in our numbers from before, that means we're losing $10,000 of our total SALT deduction that we were able to deduct without limit in 2017. Oh no, what's that going to do to our tax liability? Well, assuming we have the same $10,000 of charitable contributions, our total itemized deductions have gone down by $10,000. If our tax rate is also the same as in 2017, our tax will go up by $2,000. Note that tax rates for 2018 are not the same as 2017, so again, this is not a realistic example, and is only being used to show the mechanics of income deductions and credits. This new line on Schedule A is the SALT deduction cap. This deduction cap by itself is not that complicated, but as we'll see shortly, the interface between this cap and state tax credit programs can get quite complicated indeed. Before we get there, we need to lay a little bit more groundwork. This will help us not to get lost in the terminology used within the legal documents we'll need to get through in order to understand the controversy. So let's take a quick look at the United States Code. This may or may not be obvious, but the IRS who drafts all these tax forms, like the Form 1040 and Schedule A, does not have the authority to tell us what's taxable, what's deductible, and what qualifies as a credit. That job is left to Congress, who writes all law, including the tax law. All of these laws are collected together and sorted by topic in the United States Code. The Internal Revenue Code is contained within Title 26 of the United States Code. Each title in the code is further broken down into a strict hierarchy that includes subtitles, chapters, subchapters, parts, subparts, etc. Unfortunately, a lot of these things like part numbers and subpart letters repeat throughout the title, so they're not very useful when it comes to navigating the enormous amount of material. Luckily though, section numbers do not repeat within a title. For this reason, most everyone refers to the Internal Revenue Code by section number. The particular section number that deals with taxes as an itemized deduction is Section 164. Here we have Section 164 as it existed on January 6, 2017. Here's the second page, and as you can see, paragraph B ends with B5H II, requirements for tables. Now, let's look at Section 164 as it existed on September 23, 2019. As you can see, there's a brand new paragraph, B6. This is where the SALT deduction cap was added into the law as part of the Tax Cuts and Jobs Act of 2017, also referred to simply as the 2017 tax reform. Okay, one more code section, and then we'll be ready to get into the meat of this thing. This is Section 170. This is what allows the deduction for charitable contributions. This is Section 170C, which gives the definition of charitable contributions. We will see this referred to quite a bit as we move along. Now that we've gotten that out of the way, let's turn our attention to this concept of state tax credit programs. What are they and how do they work? Since we are a Georgia firm, I'm going to use a Georgia program as an example. This is the Georgia statute authorizing the Qualified Education Tax Credit, which came about in 2008. So how does this program operate? Big picture, it's like this. For the 2018 tax year, the state of Georgia agreed to forego $58 million of tax revenue if Georgia taxpayers agree to donate that amount to student scholarship organizations, which in turn provide scholarships to students attending private schools. This is accomplished by allowing taxpayers who make these donations to take a tax credit against Georgia income tax. Individuals who file as single or head of household may receive a maximum tax credit of $1,000. Married couples may receive up to $2,500. Owners of pass-through business entities may receive a credit up to $10,000 if certain conditions are met, and corporations can offset up to 75% of their Georgia income tax liability. How does the state of Georgia track this? How do they know only $58 million was taken as tax credits in 2018 related to this program? Well, as with most things tax, this is done through paperwork. Oh, and by the way, the cap on this is $100 million for 2019 through 2028. The Georgia Form IT-QEE-TP1 is used to request pre-approval to contribute whatever amount is desired and allowed depending on the taxpayer's circumstances. This form is also used to identify the student scholarship organization to which the donation will be directed. If the $58 million allotment has not been used up by other taxpayers yet, this request will be approved. Once it is approved, the donation may be made. The student scholarship organization then sends the taxpayer this form, IT-QEE-SS01, which confirms both the pre-approved amount and the contribution amount. Finally, the taxpayer has to fill out this form and attach it to his or her or the company's Georgia income tax return, and the credit is taken against Georgia income tax. This is the paper trail that assures Georgia is allowing the correct amount of tax to be redirected to this program through an income tax credit. If the taxpayer does not have the proper form, the credit may not be taken. Here is another Georgia program that is more recent. The Georgia Credit for Contributions to Rural Hospital Organizations was added to Georgia law in 2016. This credit is similar in many ways to the Qualified Education Tax Credit, but the limits for individuals are higher. Single taxpayers can get a credit up to $5,000, and taxpayers who are married filing jointly can get up to a $10,000 credit. Pass-through business entity owners may receive a credit up to $10,000, and a corporation may offset 75% of the corporation's Georgia income tax liability, much like the Qualified Education Tax Credit. The cap on this one is $60 million. So that's two examples here in Georgia of state programs where an income tax credit is provided by the state dependent on a charitable donation being made to a third party. There are also other types of programs that may offer credits for different types of state taxes, such as property taxes, and for different types of transactions, such as the donation of real property. The question then is, how should these transactions be treated on the federal income tax return? When a Georgia taxpayer takes advantage of the Qualified Education Credit Program, the donation to a student scholarship organization has effectively no cost. A single individual may donate up to $1,000, and if all the paperwork is done correctly, receive a state tax credit for $1,000. Charitable donations to other qualifying entities that are not part of one of these programs would also generally result in a reduction of federal and state tax liabilities through the charitable donation deduction, but not to the same extent. The top marginal tax rate in Georgia for 2018 was 6%. So a regular $1,000 charitable donation deduction would reduce Georgia income tax by only $60. For federal purposes, should a state tax credit offered through a state tax credit program equal to potentially 100% of the amount donated be treated differently than a state tax deduction, where the benefit is limited by the state's tax rates? As these programs became more popular, IRS agents around the country started wondering the same thing. Much like us, when IRS agents have questions, they ask their boss, and on October 27, 2010, the boss responded. Welcome to CCA 2011-05010. CCA stands for Chief Counsel Advice, and that's exactly what it is. The Chief Counsel of the IRS is a lot like a Chief Counsel in a company. He or she is responsible for advising the Commissioner of the IRS, as well as all other IRS attorneys and staff on legal matters. In this case, it looks like Vicki L. Miller from Kansas City had a couple questions. Oh, and notice right here in the beginning where it says, this advice may not be used or cited as precedent. That means the answer to her questions that we'll see in here do not have legal authority. They are just opinions. So these CCAs may not be relied upon in a court proceeding or even in an audit, but are still useful to us since it gives us an idea of what the IRS is thinking, even though it's not binding on them or us. When we look at Vicki's first question, the reason we spent that time looking at those code sections becomes clear. She's asking if a taxpayer pays cash to a state agency or charitable organization and receives a tax credit from the state, how should that be treated for federal income tax purposes under sections 164 and 170? The second question asks about property, which would generally come up in the context of conservation easements, and that's a whole other topic, so we're going to skip that for now. So what's the answer? Well, here's how it turns out. When a taxpayer participates in a state tax credit program, the payment to the third-party charitable organization is a charitable donation under Section 170, not a state tax deduction under Section 164, regardless of the fact that it's part of a state tax credit program. The reasoning goes like this. To be deductible under Section 170, the transfer to the organization or governmental unit must be a gift. A gift for this purpose, as defined by case law, is a transfer of money or property without adequate consideration, made with charitable intent. Consideration would be a return of money or benefit of some sort. For example, charitable organizations often hold events such as dinners or galas to raise funds. If you pay $200 to attend a charitable dinner and the food is worth $50, then you only get to take $150 at a charitable donation, because a benefit or consideration of $50 was received in return. Okay, so if a benefit is received, the donation is reduced by the amount of the benefit. Well, does that apply in this case? The next part of the analysis states that tax benefit of federal and state charitable contribution deductions has never been regarded as a return benefit that negates charitable intent. Okay, so the issue to be decided is, should a tax benefit in the form of a state tax credit be treated differently? The conclusion in this CCA is no. A state tax benefit in the form of a state tax credit, regardless of amount, is not treated as a return benefit or consideration that might constitute a quid pro quo that would reduce or eliminate charitable intent, and is also not treated as income. The federal treatment put forth in this opinion is that the state and local tax deduction under Section 164 is reduced by the amount of the credit received, and the charitable donation deduction is taken at full value, unreduced by the amount of the state tax credit. So what is the practical result of this CCA? Let's go back to the 2017 Schedule A and take a look at what happens. Let's say that our taxpayer from before decided to take advantage of the Georgia Qualified Education Tax Credit. Our taxpayer filled all the appropriate forms and took a $1,000 credit on their Georgia income tax return. What would that do to the federal Schedule A? According to the CCA we just went through, the proper treatment is to reduce state income taxes reported on line 5 by the amount of the credit, which is $1,000 in this case, and report the amount of the contribution as part of other cash contributions on line 16, which is also $1,000 in this case. The impact on the 2017 Schedule A then is zero, because all we've done is moved the $1,000 from one place to the other. In other words, under pre-2018 law, there was no impact to this on the federal return. Well, sort of. There is one case where this mattered even in 2017 and before, and that was when the taxpayer was subject to the Alternative Minimum Tax, or AMT. We're not going to spend much time on that here, but basically the way AMT works is it adds a number of deductions back into taxable income, including state and local taxes, but charitable donations are still allowed. Therefore, moving deductions from taxes you paid to gifts to charity decreased alternative minimum taxable income and, therefore, alternative minimum tax. That was a fairly special case, but it did help people in that situation. So what was the situation starting in 2018? Well, let's go back to our 2018 Schedule A. In this case, we can only deduct $10,000 out of our total state taxes of $20,000. So if we move $1,000 of deductions out of taxes you paid down to gifts to charity, this increases our total itemized deductions by $1,000. Yay! Here's an excerpt from an email I personally sent to a client on March 9th, 2018, explaining how this would be beneficial to them in 2018 due to the new SALT deduction cap. In this case, we were planning to take advantage of the Georgia Rural Hospital Program and stood to make around $2,400 on the deal. Yay again! But then, everything changed. On May 23, 2018, the Treasury and IRS issued Notice 2018-54. In this notice, they announced their intention to issue proposed regulations dealing with, quote, certain payments made by taxpayers for which taxpayers receive a credit against their state and local taxes, unquote. As we just saw in the 2010 CCA, these programs have been around for some time, and the Treasury has not been that interested in providing formal guidance. So why are they so interested in doing so now? Well, there are really two reasons. One is that with the introduction of the SALT deduction cap, these state tax credit programs that have been around for some time have suddenly become more advantageous, even for those who are not in AMT, like my client from the email. But I think the bigger impetus was the fact that states with higher income and property taxes, such as New York, New Jersey, and California, were quite unhappy with the new SALT deduction cap and began passing legislation that would essentially allow their citizens to get around the new cap by setting up charitable funds controlled by the state to which taxpayers could make a donation and receive a state tax credit. Due to the way this notice was written, we had a glimmer of hope when it first came out that it would only apply to the newer programs involving state-run charitable funds and would leave the federal treatment of the pre-TCJA programs like Georgia's Qualified Education and Rural Hospital State Tax Credit programs as they were. Unfortunately, that turned out not to be the case. It's important to understand the difference between something like a CCA and regulations. The drafting of regulations is a formal process governed mostly by the Administrative Procedures Act, or APA. First, there has to be notice of proposed rulemaking, which is what this notice is, then a comment period, hearings, etc., and the new rules must conform to particular standards. Once this process is complete, final regulations may be issued. So, what are regulations? Well, they are rules, usually of an interpretive nature, written by an administrative agency that once finalized had the same legal authority as statutory law. In other words, unlike the CCA, they cannot be cited as precedent and is not binding on either the IRS or us. Regulations are binding and must be followed. They are, however, subject to judicial review and may be overturned if found to be lacking in some way. The importance of this notice, then, is the regulations they are proposing to write will take precedent over the 2010 CCA, and if they reach a different conclusion, we'll have to change the way we treat these arrangements. On August 27, 2018, the IRS released proposed regulations under Section 170 dealing with this issue. The document is rather lengthy, but basically what it says is the 2010 CCA was wrong. The receipt of a state tax credit as part of a state tax credit program is a quid pro quo, and this reduces the charitable donation to the extent of the benefit received. In a practical sense, that means the deduction will no longer transfer from the taxes you paid line to the gifts to charity line. I think the most useful part of the proposed regulations is the chart they prepared in the back that shows the tax impact of the prior law, the baseline, which is the law as updated by the TCJA but before these regulations, and proposed rule, which shows the tax impact after these regulations. Column A shows the impact of a $1,000 donation to a charitable organization as part of a state tax credit program, and column B shows a $1,000 donation to a regular charity. Example 3 at the bottom shows the AMT situation we talked about before. The taxpayer in prior law, column A, is earning $260 on the arrangement, since $1,000 becomes deductible that wasn't deductible before, and the taxpayer is in the 26% AMT bracket. Example 1, baseline column A, represents the state efforts to circumvent the new statutory limitation on state and local tax deductions, as described in the notice. These are people who are over the SALT deduction cap, but are able to deduct previously non-deductible state taxes by moving them to the charitable donations line. This was my client's situation, and as mentioned previously and made clear in these proposed regulations, these new rules do apply to programs that were around prior to the 2017 tax reform, just the same as the newer programs. The proposed rule scenarios show that, under the new regulations, the federal treatment can be either neutral or detrimental, but there will not be a situation where a taxpayer could make money in one of these programs based on the federal treatment. And, in case you're wondering, these new rules do apply to estates and trusts as well. There is a de minimis exception, though. If the amount of the state or local tax credit does not exceed 15% of the amount paid or the fair market value of the property transferred, these new rules may be disregarded, and a full charitable donation may be taken just as before. Speaking of exceptions, on September 5, 2018, the IRS put out 2 very interesting documents on their website dealing with exceptions for business taxpayers. The first is IR-2018-178. It states that a business taxpayer, regardless of the form in which the business operates, may deduct a presumably disqualified charitable contribution as long as the payment qualifies as an ordinary necessary business expense under Section 162. When I first read this, I honestly wasn't quite sure what the IRS was getting at, and here's the reason why. If we go back to the hierarchy of the United States Code we looked at before and zoom in a little bit, you'll notice the title of Part 6 is Itemized Deductions for Individuals and Corporations. This part includes both regular trade or business expenses under Section 162, as well as charitable contributions under Section 170. In other words, both individuals and corporations deduct charitable contributions under Section 170, not Section 162. This would also apply to a pass-through business entity that is not a corporation, because these entities are really not considered to be quote-unquote entities for most purposes, but really an aggregate of their owners, which are generally individuals. So if we look at a Schedule K-1 that'd be issued by a pass-through entity organized as a partnership, we see that ordinary business income and loss is reported in Box 1. This would include, in general, revenue less ordinary and necessary business expenses under Section 162. But charitable contributions are reported in Box 13 as part of other deductions. 13A would be the most common, a regular cash contribution. When an individual receives a K-1 like this from a partnership entity, the amount reported in Box 13A is carried to the individual's Schedule A, just as if the individual had made the charitable contribution themselves. Also, if we pull up Section 162, we find that subsection A gives the basic definition of an ordinary and necessary business expense, and subsection B states that no deduction shall be allowed under subsection A for a charitable contribution which would be allowable under Section 170 were it not for the, quote, percentage limitations, the dollar limitations, or the requirements as to the time of payment, unquote. So, under what circumstances can we deduct a charitable contribution under 162? The FAQ provided by the IRS on the same day gives us a little clue. It states that charitable contributions made with a, quote, business purpose may be deducted as an ordinary necessary business expense. Okay, so what gives rise to an appropriate business purpose in this context? We find our answer here in Regulation Section 1.170 Cap A-1C5, which states that a transfer of property to a charitable organization made with a reasonable expectation of financial return commensurate with the amount of the transfer would not qualify as a charitable donation, but may be a trade or business expense under Section 162. So what's an example of a situation where this might come into play? For that, we turn to the Singer Company case. This case has a little age on it, as it was decided in 1971 for the company's 1954 tax year, but it's still relevant. The facts go something like this. The Singer Company manufactured and sold sewing machines in the United States and abroad. In the year at issue, they had a policy of selling new machines at a substantial discount to schools and certain other charitable organizations. When they sold these machines, they took a charitable donation deduction for the difference between the fair market value of the machines versus the discounted selling price, as allowed under the Section 170 regulations. The court determined that the discounted sales to the schools did not qualify as charitable donations because there was a quid pro quo. The nature of that quid pro quo was that the machines were sold at a discount to schools for the, quote, predominant purpose of encouraging those institutions to interest and train young women in the art of machine sewing, thereby enlarging the future potential market by developing prospective purchasers of home sewing machines, and more particularly, Singer machines, the brand on which the future buyers learn to sew, unquote. Does that mean all is lost? No, exactly because these transactions were entered into with an expectation of financial return and thus fail to be charitable donations, they qualify as ordinary necessary business expenses. So here's the question. If a transfer to a charitable organization fails to be a charitable donation under the new proposed regulations because a quid pro quo in the form of a state tax credit is expected to be received, does that transfer qualify as an ordinary and necessary business expense? The answer is yes. But don't get too excited. The scenarios where this would apply to most business owners are fairly narrow. Revenue Procedure 2019-12, which was issued on December 28, 2018, formalizes a safe harbor referred to in the news release and FAQ. Notice right in the beginning a big change from the prior documents. This RevProc only applies to C corporations and specified pass-through entities, not at all to sole proprietorships or disregarded entities. Here, the RevProc states that a state tax credit in fact does qualify as a reasonable expectation of financial return, and so can be considered a Section 162 business expense. The problem is that it only works for state taxes imposed at the entity level. For a C corporation, that's not a big deal since it incurs federal and state taxes at the corporate level. In the case of a pass-through entity, though, it greatly reduces the applicability of this safe harbor. In one of the examples provided, P, an LLC taxed as a partnership, receives a state tax credit for excise taxes incurred at the partnership level. This amount will not qualify as a charitable donation, but may be deducted under Section 162. Any taxes incurred at the partner level due to income passing through to the partner, however, would be outside the scope of this safe harbor. Interestingly, no similar safe harbor is provided for a sole proprietorship or disregarded entity, so presumably, if a Schedule C business had the same facts as Partnership P in the example, it appears it would not be able to deduct the payments under Section 162, even if it's related to a state credit against a tax imposed on the business, like the excise tax in the example. To sum up, business owners cannot have their businesses pay into state tax credit programs to obtain credits against state taxes imposed on the owners of the business and expect to deduct those amounts as business expenses under Section 162. This safe harbor is only applicable to taxes incurred by the entity itself. On June 11, 2019, the Treasury and the IRS released the final regulations, which were published in the Federal Register a couple days later. The final regulations as issued were pretty much unchanged from those proposed back in 2018, despite having received quite a bit of public commentary. Let's take a look at example 1 provided in the regulations just to cement what they really do. Okay, A, an individual makes a payment of $1,000 to X, an entity described in Section 170C. In exchange for the payment, A receives or expects to receive a state tax credit of 70% of the amount of A's payment to X. Under paragraph H3I of this section, A's charitable contribution deduction is reduced by $700, which is 70% times $1,000. This reduction occurs regardless of whether A is able to claim the state tax credit in that year. Thus, A's charitable contribution deduction for the $1,000 payment to X may not exceed $300. Okay, that seems pretty clear. The 70% credit is greater than the 15% de minimis exception, so the charitable donation is reduced by the amount of the credit, which is $700 in this case. So what happens to that $700? Is it just lost? As we just learned from Rev Proc 2019-12, if this were a business taxpayer, the $700 would be deductible as a business expense under Section 162. Is there a corollary for individual taxpayers? To clear this up, the IRS issued another Notice of Proposed Rulemaking, this time under Section 164. It states that an individual may treat as a payment of state or local tax for purposes of Section 164 the portion of a payment for which a charitable contribution deduction under Section 170 is or will be disallowed under the final regulations we just talked about. In our example from before then, the $700 that is disallowed as a charitable donation may be deducted as a state or local tax under Section 164. Of course, that means it will be subject to the $10,000 SALT deduction cap provided in Section 164b6. So the taxpayers this really helps are those whose deductible state tax liabilities are under the $10,000 SALT deduction cap to begin with. Still not happy with the SALT deduction cap and very much not happy with the final regulations issued in June 2019, the states of New Jersey, New York, and Connecticut sued the federal government in district court on July 17, 2019. On September 30, 2019, the district court dismissed the case. The opinion is super interesting and includes a brief history of the SALT deduction for federal purposes all the way back to the formation of the Union. But the crux of the matter is this. Although the SALT deduction cap is novel in that an unlimited SALT deduction has always been allowed throughout the country's history whenever an income tax has been imposed, it is not constitutionally required. And the fact that this new deduction cap impacts some states more than others also does not impair constitutionality because it, quote, operates with the same force and effect in every place where the subject of it is found, unquote. Therefore, according to the district court, the SALT deduction cap is here to stay, at least until it ends by itself in 2025. It's possible these states will appeal the ruling or that Congress may take action, but for now, I think it's safe to assume we will need to deal with this on the 2019 returns that we're getting ready to file here pretty soon in the 2020 filing season. We just covered a lot of material, so let's do a quick recap of what we've learned. The Tax Cuts and Jobs Act of 2017 created a new state and local tax deduction cap equal to $10,000 or $5,000 if married filing separately. Under the 2010 CCA, the federal treatment of charitable state tax credit programs has been to deduct the amount paid as a charitable contribution and reduce the SALT deduction by the amount of the state tax credit. The SALT deduction cap made these programs more advantageous because they converted non-deductible SALT deductions into deductible charitable contribution deductions. Taxpayers in states with high state and local taxes were hit particularly hard by the new SALT deduction cap. In response, some of these states began creating new charitable state tax credit programs to give their citizens a way to get around the new federal deduction cap. In May 2018, the Treasury and the IRS responded with a notice of proposed rulemaking under Section 170, Notice 2018-54, stating that regulations would be written to address this issue. In August 2018, proposed regulations were released that reversed the position of the 2010 CCA. State tax credits received related to charitable contributions would now be considered a quid pro quo, which would reduce the charitable contribution to the extent of the state tax credit received in excess of a 15% de minimis exception. In December 2018, Rev Proc 2019-12 was released, providing a safe harbor whereby a C corporation or specified pass-through entity may deduct any amount disallowed under the proposed regulations related to a state tax credit received for taxes incurred at the entity level as an ordinary and necessary business expense under Section 162. In June 2019, final regulations were issued under Section 170, pretty much unchanged from the proposed regulations. Also in June 2019, notice of proposed rulemaking under Section 164 were issued. Notice 2019-12, stating that individuals for whom a charitable donation deduction is reduced or eliminated under the final regulations under Section 170 may deduct this amount as a state or local tax expense under Section 164. This eliminated the detrimental effect of the proposed regulation shown in Example 2, Proposed Rule, Column A. In July 2019, a lawsuit was filed by the states of New Jersey, New York, and Connecticut, attempting to block the new regulations and arguing the SALT deduction cap was unconstitutional. In September 2019, the case was dismissed, and the SALT deduction cap was held to be constitutional. It's possible there could be more legal challenges, but unless Congress decides to make a change, it's likely to be in effect at least until its sunset date in 2025. Thank you for taking the time to go through this rather interesting provision with me. I hope this has provided some value and that you've enjoyed watching this presentation as much as I've enjoyed putting it together. If you have any questions at all, please do not hesitate to reach out. See you next time.